Welcome to Trading Nation. I'm Seema Modi. Chinese tech stocks are selling off sharply Wednesday, with investors uncertain what could come of the ongoing tensions between the United States and China. Monday's meeting between President Joe Biden and President Xi Jinping doing little to calm the volatility in this group, which has seen very choppy trading since the Chinese government began to crack down on U.S.-listed technology companies this summer. Do these swings present any opportunity for investors? Let's bring in Ava Ottos of ER Shares and Bill Baruch of Blue Line Capital. And Bill, those who traded these stocks in the short term, they perhaps did well, but for the long term, all these stocks, Alibaba, Baidu, JD, they're sitting on big losses for the year.
Thanks, Seema. And I agree with you. They're down big, and it's not a place that I want to be. I don't own any of these stocks. I don't own them for my clients. I'm worried about the uncertainty of policy going forward, and I think that that has been increased after President Xi has been announced ruler for life. So he now can massage policy for longer than, say, an investor's timeline. So it really leaves a lot of uncertainty, with these stocks. Fundamentally, too, from a macro perspective, I think I'm not so bullish on China growth over the next at least quarter or two. And looking at commodities like copper making a 5-week lows today. So, on top of that, inflation is pretty high in China right now, too. So the People's Bank of China, their hands are pretty tied. So I'm just not very upbeat about China in general right now. But from you, like you mentioned, there has been a trading opportunity per se. There's been you look at KWEB, the Chinese banking ETF, Chinese tech ETF, had big trendline support over the last 2 months, bounced off it a couple times. There's been 15-20% swings higher from the lows. There's definitely trading opportunities. That's not for me. But if you look into those opportunities, that as it's rallied, there's thick resistance into that July sell-off, and the market continues to stall there. So I wouldn't be surprised to see this ETF make and forge new lows in the coming months.
Although, Ava, there are some analysts or investors who would say you can put regulation and politics to the side. That's just noise. Look at the compounded annual growth rate for a lot of these companies, and they are still being able to capitalize on the growing middle class in China.
Well, we have been, I agree with your other guest. I think China is not the place to be right now. In fact, we have been decreasing our exposure in China for many months now. We think the Evergrande event will become a contagion. We are seeing it starting with companies like Evergrande. We have to remember that 50% of the global distressed debt, dollar denominated, is in China, and the companies that have a very high debt to equity ratio will have a very tough time refinancing it. Now, we have seen material prices coming down over the last month. In fact, some metals are down up to 20% for the month. And that means that, and those commodities are highly correlated to construction. As 15% of China's GDP is in real estate, we think we'll see more of these commodities coming down in the next month or so. And we think that the silver lining in the dark cloud is that this will relieve inflationary pressures that we're seeing right now.
Okay, 2 no's on China. Easy to hear where you guys stand there. Thank you to you both for joining me today, Bill and Ava. And thank you all for watching Trading Nation. I'm Seema Modi.